Friends, thank you for being here today. What if I told you that the staggering $2.4 billion loss reported by JP Morgan this past Friday was not merely an error in judgment, but the visible smoke from a fire that has been burning in the basement of the global financial system for decades? And is it possible that this unprecedented disclosure is actually a calculated signal, a starting gun indicating that the world's most powerful bank has quietly switched sides to engineer the very squeeze they are publicly suffering from? To understand the magnitude of what occurred on Wednesday, December 17th, and the revelation that followed in the regulatory filings, we must peel back the layers of a complex financial onion. We are not just looking at a bad trade. We are witnessing a structural fracture in the precious metals market that separates the paper reality we see on our screens from the physical reality occurring in the vaults. This is a story of algorithmic warfare, forensic accounting, and a supply coup that rivals the Hunt brothers' attempt in 1980. To understand how we got here, we first need to dissect the catalyst behind the technical breakout and the resulting gamma squeeze for months. The entire financial establishment, through technical charting and managed rhetoric, insisted that $65 per ounce was the absolute ceiling for silver. It was painted as the line in the sand, imagine a line defended by the bullion banks with every paper contract at their disposal. They told us that supply would overwhelm demand at that level, that the industrial users would balk, and that the monetary authorities would never allow a breach. But on Wednesday, December 17th, the market voted, and the market chose violence. We did not just touch $65. We smashed through it with a velocity that suggests a total absence of sellers. The price spiked aggressively to $66.50 before pulling back to consolidate around the $65.80 level. As we speak, many of you are looking at that pullback, that drop from the daily high, and feeling the creep of fear. You are asking if this was a fake-out, a trap designed to lure retail investors in before a massive dump. However, to interpret this price action as weakness is to misunderstand the anatomy of a breakout. What we are witnessing is the most critical technical behavior a healthy market can exhibit: a retest. The concrete roof that was $65 has been shattered, and now the market is standing on top of the rubble, stomping on it to ensure it is solid enough to serve as the new floor. To truly comprehend why silver essentially teleported from $64 to $66.50 in a matter of hours, one must understand the plumbing of the modern derivatives market, specifically a force known as gamma. Gamma is a measure used by options traders to determine how fast their risk exposure changes. Think of the market makers, the entities that sell options, as the house in a casino. For months, they sold millions of ounces worth of call options at the $65 strike price. These options are bets that silver will go up. As long as silver remained below $65, the house was winning. Those options were worthless expiring paper. However, the moment the price crossed $65, the mathematics flipped. The house started losing. And due to the nature of options leverage, they began losing exponentially. When the price hit $65.10, the risk management algorithms at these firms screamed danger. To protect the banks from losing billions, these computers automatically bought silver futures contracts to hedge their exposure. They didn't buy because they liked the fundamental case for a silver. They bought because the math forced them to. This created a gamma squeeze. Their buying pushed the price to $65.30, which increased their risk further, forcing the computer to buy even more, driving the price to $66. This is a forced feedback loop, a vacuum move where there were no human sellers, only desperate machines cannibalizing the order book to cover their exposure. Why, then, did it stop at $66.50? Why the pullback to $65.80? This is where the human element returned. Traders saw the vertical line and took profits. And the gamma buying exhausted itself. But lurking beneath this volatility is a massive stabilizing force, the whale. Throughout the morning, massive block orders appeared on the bid side at $65.75. This tells us that smart money entities with hundreds of millions of dollars believe $65 is cheap. Last week, they were buying at $63. Now, they're defending the $65 level, building a base camp for the next advance. This pullback is not a failure. It is the market building the launchpad for the next leg higher, confirming that the psychological barrier has been broken. Now, let's shift our focus from the charts to the ledger, where forensic accounting reveals the true depth of J.P. Morgan's to point for $1 billion loss. While the technical breakout was happening on the charts, a much darker story was unfolding in the regulatory filings of the United States' largest bank on Friday afternoon, a time traditionally reserved for burying bad news. J.P. Morgan Chase filed their quarterly commodity derivatives disclosure with the Office of the Comptroller of the Currency. Buried in the footnotes was a number that should send a shockwave through every boardroom on Wall Street: an unrealized loss of $2.4 billion on their commodity trading portfolio. The bank did not specify which commodity caused the loss. They did not break down the numbers for the public, but forensic analysis allows us to reverse engineer the truth. We know that in the last 6 weeks, gold moved roughly for 0.6%, and platinum and palladium were relatively flat. The only commodity that moved violently enough, surging 128% from roughly $28 to $64 to generate a multi-billion-dollar hole in a derivatives book is silver. By cross-referencing the loss with a price movement, we can estimate the size of J.P. Morgan short position. If they lost $2.4 billion on a $36 price move, simple division suggests a short position of approximately 66.6 million ounces. Let that sink in. J.P. Morgan appears to be short roughly 67 million ounces of silver. That is nearly 8% of the annual global mine supply, and more than the entire country of Mexico produces in a year. However, the reported $2.4 billion figure is likely a fabrication of optimism, a best-case scenario accounting trick. Banks rarely mark their massive liquid positions to the spot price Mark II market. Instead, they often use Mark II model, valuing the position based on where they believe they could exit over time. A former risk officer at a major bullion bank might tell you that while the market price is $64, the bank is valuing its liability as if they could cover at $58. This $6 discrepancy per ounce, across 67 million ounces, would mean there is another $400 million to $500 million in losses hidden off the books. Furthermore, this analysis does not account for the Greeks' derivatives exposure. As mentioned regarding the gamma squeeze, losses on options do not move linearly. If silver moves from $64 to $70, the loss doesn't just increase by 9%. It could jump by 20% or 30% as the risk accelerates. Conservative estimates suggest that J.P. Morgan's real Mark II market loss at $64 silver is likely between $3.5 billion and $5 billion. At $80 silver, that loss could balloon to $8 billion. At $100, they are staring at a solvency crisis with losses exceeding $15 billion. Why disclose this now? They had no choice. Regulations like Dodd-Frank and Basel III require banks to disclose material risks that threaten their Tier 1 capital ratios. At $2.4 billion loss crosses the threshold of materiality. It affects Their capital reserves. Every dollar silver rises, the bank must pull millions of dollars from its operating capital to post as collateral margin. This is dead capital money that cannot be used for lending, trading, or paying dividends. The disclosure confirms that the situation has spiraled beyond their control. They are not managing the market anymore. The market is managing them. I want to pause here and ask you a critical question. Do you believe this $2.4 billion loss is a genuine blunder by JP Morgan? Or is it just the tip of the iceberg that they are finally forced to admit? Let me know your thoughts in the comments below. This financial hemorrhage leads us to the inevitable question of why the banks cannot simply exit their positions, effectively sealing themselves in a trap of their own making. The question on everyone's mind is simple. If JP Morgan is losing billions, why don't they just buy the silver back and close the position? The answer reveals the terrifying nature of the trap they have built for themselves. They cannot exit because the door is too small for an elephant of that size. To close a short position of 67 million ounces, you need sellers. You need liquidity. But the current registered inventory at the COMEX, the metal available for delivery, stands at roughly 30 million to 50 million ounces. JP Morgan is short more silver than exists in the registered vaults of the exchange. If they attempted to buy 67 million ounces on the open market, they would trigger a phenomenon known as slippage, but on a catastrophic scale. The first buy order would clear out the order book at $65. The next would have to be filled at $70, then $80, then $100. Their own buying would send the price vertical, effectively guaranteeing that they realize the maximum possible loss. They are left with three escape routes, all of which lead to failure. First, the slow cover. They could try to buy back slowly, perhaps 1 million ounces a week, hoping not to spook the market. But at that rate, it would take 67 weeks, all over a year, to close the position. The market is too smart for this. Algorithms and hedge funds would sniff out the persistent buying pressure. They would front-run the bank, buying ahead of them and forcing prices up anyway. By the time JP Morgan covered half their position, silver would be at $100. And they would have spent billions chasing the price. Second, regulatory intervention in 1980. When the Hunt brothers cornered the market, the regulators changed the rules. They implemented Silver Rule 7, which allowed for liquidation-only trading. You could sell, but you couldn't buy. This crashed the price. JP Morgan might hope for a similar bailout, however. The landscape has changed. The 1980 rally was driven by paper speculation. The 2025 rally is driven by industrial desperation. Solar panel manufacturers, electric vehicle companies, and battery makers need physical silver to operate. If the CFTC shuts down the paper market, Samsung and Tesla will not stop buying. They will just move to the physical market, causing the paper price to crash while the real price of silver explodes to infinity. This would decouple the markets and render the COMEX irrelevant. Third, cash settlement. This is the nuclear option. The exchange could declare a force majeure, claiming that due to extraordinary circumstances, they cannot deliver the metal. They would force contract holders to accept a cash payment instead of silver. For example, they might say, "We can't give you silver, but here is $65 per ounce in cash." While this might save the bank from bankruptcy in the short term, it destroys the product. If a futures contract is no longer a valid promise of delivery, trust evaporates. Investors would take that cash settlement and immediately rush to buy physical metal, creating a hyperinflationary loop in the physical market. The bank is trapped in a cascade. Every day silver stays above $64, they bleed margin. Every week that passes, the physical shortage worsens. We are likely 2 to 6 weeks away from a systemic event. Once the internal risk committee at the bank decides the position is untenable, they will order a forced liquidation. This is the moment the dam breaks. When J.P. Morgan is forced to buy at any price, and the rest of the short sellers Bank of America, HSBC, Scotia see the giant falling, they will all rush for the exit simultaneously. This stampede is what will drive silver from $64 to $120 and beyond in a blink of an eye. But the paper losses are only half the story. We must now confront the physical disconnect widening between the screen price and the real shadow price of the metal. To truly understand the precariousness of the situation, we must look away from the ticker tape on CNBC and look at the real world. The screen price of $65.80 is becoming an illusion, a paper price that represents a promise, not a commodity. There is a massive disconnect emerging between the spot price and the shadow price, which is the actual cost to secure physical metal in volume. Reports are flooding in from the industrial supply chain that major users are bypassing the COMEX entirely. A solar panel factory cannot run on paper contracts. They need silver paste. If the COMEX delivery is delayed or uncertain, these companies face millions of dollars in losses from stalled assembly lines. Consequently, they are going directly to miners and refiners, offering $70 or more per ounce to secure immediate delivery. This $70 is the shadow price, the real clearing price of the metal for those who actually need it. The paper market is becoming a distorted mirror, reflecting a reality that no longer exists. This disconnect is trickling down to the retail level. If you try to buy a monster box of Silver Eagles today, you are not paying $65.80. You are likely facing a premium that pushes the price to $75 or $80. Dealers are widening their spreads because they are terrified of replacement costs. They know that if they sell a coin today at $65, they might have to pay $68 to restock it tomorrow. They are pricing in the squeeze before it officially happens. Furthermore, we are seeing the pre-order scam proliferate, where dealers take money for a silver they do not have, promising to ship in for weeks. This is effectively an interest-free loan from the customer to the dealer, signaling a dangerous liquidity crunch in the physical wholesale market. The data supports this. Physical drain. COMEX registered inventory has collapsed to approximately 50 million ounces. Meanwhile, open interest, the number of outstanding paper contracts, stands at roughly 950 million ounces. This creates a leverage ratio of 19 to 1. There are 19 people holding a claim check for every single ounce of silver sitting in the vault. This is a game of musical chairs where 95% of the participants are guaranteed to be left standing. When the music stops, the ultimate risk here lies with the unallocated account holders. Millions of investors hold silver in pooled accounts at major banks or in ETFs like SLV, believing they own metal. They do not. They own a credit against the bank's balance sheet in the event of a squeeze. The fine print allows the bank to settle these accounts in cash when the shadow price hits $100, but the paper price is stuck at $70 due to manipulation or rule changes. These investors will be cashed out at $70. They will be bailed in to save the financial institutions, left with depreciating fiat currency while the asset they thought they owned moves out of reach forever. Yet, there is a twist in this narrative that suggests this might be a strategic coup, driven by a theory of long accumulation that flips the entire board. However, there is a counter-narrative, one that transforms J.P. Morgan from a victim of their own incompetence into the architect of the greatest financial heist in history. What if the $2.4 billion loss is merely the cost of doing business, a calculated decoy to distract? From the real play, evidence suggests that between June and October 2025, JP Morgan executed a maneuver that defies conventional wisdom, while the headlines focused on their short exposure. Forensic analysis of vault transfers and custodial data indicates that the bank effectively flipped their position. It appears they utilized their role as the custodian for the SLV ETF to quietly transfer vast amounts of metal from allocated storage into their own proprietary accounts. The theory supported by a leaked report from the Economic Times and unusual movements in the bank's other assets balance sheet line is that JP Morgan has accumulated a physical hoard of roughly 750 million ounces of silver. This is nearly a full year of global mine production. They didn't buy this on the open market, which would have spiked the price. They absorbed it through private transfers, lease expirations, and by cannibalizing the very ETFs they manage. Consider the timing. This accumulation occurred right before the Federal Reserve began its rate-cutting cycle in December 2025. JP Morgan knows better than anyone that real interest rates are heading negative, a historically explosive environment for precious metals, by calling 750 million ounces. They have effectively removed the supply overhang that they themselves used to manipulate prices for a decade. The smoking gun for this theory is the sudden spike in silver lease rates in October. Lease rates jumped 40%, and by December, they had skyrocketed 300% to around 8%. This indicates that JP Morgan, previously the market's largest lender of silver, stopped lending. They cut off the supply lines to other bullion banks like HSBC and Scotia, leaving their competitors exposed to the naked short positions while JP Morgan sits on the stockpile. If this hypothesis holds true, JP Morgan is now net long the market. The $2.4 billion loss on their remaining paper shorts is a drop in the bucket compared to the potential gains on 750 million ounces of physical metal. If silver goes to $100, their short book bleeds, but their physical vault gains tens of billions in value. They have positioned themselves to profit from the squeeze they engineered. They are not the Hunt brothers, who used leverage and were crushed by the system. JP Morgan is the system, and they are using their balance sheet to own the asset outright, immune to margin calls. Furthermore, we must recognize that this internal banking crisis is colliding with an external geopolitical shockwave that makes the situation infinitely more volatile. If this was simply a battle between retail investors and Wall Street banks, one might argue that the regulators could eventually step in to broker peace. But there is a third player at the table, an elephant in the room that the Western financial media is terrified to acknowledge. While we have been fixated on the COMEX in New York, a geopolitical arbitrage has been quietly draining the lifeblood of the Western pricing mechanism. The center of gravity for physical silver pricing is shifting east, specifically to the Shanghai Gold Exchange (SGE). For the past year, we have witnessed a persistent premium on the SGE compared to London and New York. Silver in Shanghai has consistently traded 10% to 12% higher than the spot price in the West. This arbitrage is not an accident. It is a vacuum. China currently controls over 80% of the global solar panel manufacturing supply chain. They are not accumulating silver for speculation. They are accumulating it for industrial survival. They know that without silver, their dominance in the green energy transition evaporates, while Western banks were busy shorting paper contracts to suppress the price. The East was busy taking delivery of the physical asset. JP Morgan's flip to a net long position suggests they realized the game was up. You cannot suppress the price of a commodity when your largest geopolitical rival is willing to pay significantly more to drain your inventory. But the stakes are even higher than industrial dominance. They touch the third rail of national security. Silver is a critical strategic metal for the military-industrial complex. It is found in every Tomahawk missile, every Apache helicopter, every satellite, and every advanced guidance system. Here lies the terrifying secret. The United States government no longer has a strategic stockpile of silver. They sold the last of it decades ago, in a time of rising global conflict. This is a vulnerability of catastrophic proportions. If J.P. Morgan indeed holds 750 million ounces of physical metal, they have effectively become the central bank of silver for the United States Department of Defense. They are the only entity with enough inventory to guarantee the continued production of advanced weaponry. This fundamentally changes the nature of the price floor. The $65 level is no longer just a technical support line. It is a national security imperative. The U.S. government cannot allow the metal to disappear into private hoards or foreign vaults. They need J.P. Morgan's stockpile. This creates a scenario where the bank's hoard is protected not just by market mechanics, but by the full weight of the state. It essentially guarantees that the price cannot fall, because if it does, the metal flows to China, and the U.S. military machine grinds to halt. We are witnessing the weaponization of silver. In a world where the BRICS nations are actively moving toward commodity-backed currencies to challenge the U.S. dollar's hegemony, holding a tangible asset like silver is a defensive move against the de-dollarization of the global economy. J.P. Morgan sees the writing on the wall. The 50-year experiment of purely fiat currency is shuddering. In the New World Order, he who has the gold and the silver makes the rules. By cornering the market now, they are ensuring they have a seat at the table when the monetary system is reset. As we approach the climax of this financial drama, we must map out the endgame, establishing our targets and a survival strategy for the volatility ahead. We are standing at the precipice of a historic wealth transfer, whether through incompetence or a strategic coup. The result is the same: the era of cheap, managed silver is officially dead. We have entered the era of price discovery, a terrifying and exhilarating phase where maps no longer apply. The biggest enemy you will face in the coming weeks is not the banks, but your own psychology. Vertigo will set in. When you see your portfolio gains hitting numbers that used to take years to achieve, the urge to sell will be overwhelming. The banks count on this. They will engineer extreme volatility. $5 drops in minutes to shake out the weak hands. They want your silver before the price reaches its true equilibrium. But what is the true price? We must look at inflation-adjusted data. The all-time high of $50 in 1980 is not $50 in today's money. Adjusted for official CPI, that 1980 peak represents roughly $187 per ounce in 2025 purchasing power. If we use the shadow stats inflation data, which tracks inflation the way it was calculated in 1980, the real high is closer to $600. At $65, silver is trading at a massive discount to its historical value. It is arguably the most undervalued asset on the planet. The ultimate exit strategy should not be based on a dollar figure, because the dollar itself is the sinking ship. The goal is not to pile up more fiat currency, but to maximize purchasing power. What's the gold to silver ratio? Currently, it sits at a historically high 70-1. Geologically, the ratio of silver to gold in the Earth's crust is roughly 15-1. Historically, the monetary ratio has averaged around 40-1 or 50-1. When the squeeze goes parabolic, silver will likely outperform gold. If the ratio drops to 30-1, that is your signal. That is the moment to swap your volatile, overvalued silver for a stable, monetary gold. By doing this, you can effectively double your gold stack without ever touching a dollar. Alternatively, look at the ratio of silver to real estate in 1980. 800 ounces of silver could buy a median home. Today, it takes 6,000 ounces. When that ratio closes, when a monster box can buy a farmhouse that is the moment to exit. If you are finding value in this investigation and want to stay ahead of this developing crisis, please hit the like button and subscribe to the channel. We will be tracking this story every single day. And you don't want to miss the next update, friends. Wednesday, December 17th, 2025. Will be remembered as the tipping point, the day the $65 wall fell, the day the banks lost control. The genie is out of the bottle, and you cannot put the toothpaste back in the tube. The world now knows that silver is scarce. The industrial giants know they must pay up to survive. JP Morgan has seemingly flipped the board, preparing to feast on the carcasses of their competitors. You are already seated at the table. You saw this coming when the rest of the world was asleep. Your job now is simple. Hold fast. Do not sell your lifeboat to buy a ticket back onto the Titanic that is the fire currency system. The squeeze has just begun. Thank you.